I guess there's three things. One is the fundamentals are still there. The second thing is the reasons people have been buying gold still remain intact. That certainly hasn't changed. And the third thing I would say is that the gold going from 3,300 in August to over 4,000 today, you would be delighted, right? If you'd been away on a vacation somewhere for the last 2 weeks and didn't know it had got even higher. So, I mean, I think if we look in this in context, yes, this is absolutely, the last 2 days we've had absolutely very sharp declines. But if we look at it in context, I'll say a few things. First of all, you said, we're only back to where we were less than 2 weeks ago, less than 2 weeks. Second point I would make is that even this dramatic decline for the last 2 days, as dramatic as it is less than 20%, no, less than 30% of the rally from September. So, and given that rally, as you said, was so extraordinarily sharp, when you have a pullback, you expect a pullback, frankly, of as much as 50 or even 60% of the rally as a retracement. So we haven't seen that yet. And if you look back, whether it's 2020 with COVID or 2011, obviously, 2011, 2009, 2006, we've had declines similar to this in the past. They are not, this is not, I've heard people say unprecedented. This is not unprecedented at all. And that's before you even go back to 1974. So I guess what I'm trying to say is just to put a bit of context on it. We had that very, very dramatic move from the end of August until, Monday. It was unclear how long it was going to go. And my take is that nothing fundamental has changed. I think the move was certainly overdone, and I use the expression several times, overbought, but are still underowned. There's no question it was overbought, and there was nothing fundamental yesterday that set off this decline. That's important for people to realize. It wasn't that central banks suddenly said, we don't need to diversify away from the dollar anymore. It wasn't that, we've got both in Gaza, the peace is looking a little bit fragile, but particularly in Ukraine with no meeting between Trump and Putin. There was, if anything, the news was gold bullish. There was nothing that caused this other than just the market dynamic that it had moved too far, too fast, and there were people looking to take profits and buyers saying, well, let's just wait a little bit. So that's my take. And so long term, I think, or long term, medium term even, the drivers of gold for the last 3 years, the people buying gold and even as I see the possibility for the market to continue to go up. And that is not contradictory at all. I mean, you can have a lot of risk that doesn't, what's the expression? What would I say? Doesn't come to fruition. And I'll never forget my friend Bill Barner, gave a wonderful analogy of the guy that's at the party, gets absolutely stone drunk. It's 1 o'clock in the morning. He gets into a car. He speeds home at 80 miles an hour on 30 mile an hour speed limit streets, and finally stumbles into bed. Well, the fact that he arrived in bed safely does not mean there was not any risk. And it's the same that I see with the stock market right now. So number one, it is overvalued on any fundamental basis, and I don't know how anyone can dispute that. Number two, the breadth has become even more narrow than it was. At the end of last year, it was an all-time record, the narrow breadth, meaning there's only a handful of stocks that lead in the market, and it's got even narrower over the last 10 months. So the breadth is really narrow. There's a lot of different indicators that market technicians use, the Hindenburg omens or whatever, and so on. And I'm not going to get into all of those, but all of these indicators are flashing red. and perhaps the most important one would be this ratio of insider sales to purchases. Now, there's a lot of reasons that insiders might want to sell, a lot of reasons. But there's only one reason that you buy in the market, unless you're trying to pump up your stock price. There's only one reason you buy in the market, and that is that you like it. And when the ratio of insider sales to buys is so overwhelmingly on the sell side, a multi-decade high, all of those four are indicators that the market is stretched and the next major move will be down. But none of what I've said will tell you when it's going to happen. Certainly doesn't tell you it's going to happen tomorrow morning. But from an investment point of view, I think what it does tell you is that there is increasing risk in the market. And so we're just being very, very cautious with what we buy. We're buying defensive stocks, which will tend to go down less than the rest of the market. Public participation before you can have a top. And, we know the gold in particular, but also silver. Gold and silver are very difficult to they're difficult to come up with what is the fundamental value, because with a company that makes widgets, you look at their sales revenue and you look at their price to sales and their price to earnings, and you look at whether their costs are going up, and you look at the dividend it pays. When you look at gold, well, it doesn't pay a dividend, as we know. The detractors keep telling us it doesn't earn anything. Okay. So what do you value it on? So you can value it on, the price of gold today, inflation adjusted compared with previous highs. That's one metric, but I don't think it's a be all and end all. Apart from anything else, the CPI is a very, very unsatisfactory metric to use. Now, if we went back to 1980 and used the methodology that they were using back in 1980 and used that the whole way through, well, you'd find gold is still not particularly expensive. It's more or less the same. It's more or less just kept pace with inflation over that period. You can look at gold versus the money supply, U.S. money supply, global money supply, U.S. versus debt, gold versus debt. All of these are sort of metrics you can use that give you a gauge. No one is perfect. As with a widget manufacturer, you can say, well, I'm looking at the price to earnings. Right? But you can't do that with gold. But all of these metrics, and then other people will look, and one of my favorites, frankly, is the gold to Dow. So gold versus financial assets. And that one is very, very telling. Certainly we're off the bottom. No question about that. And we're perhaps meaningfully off the bottom. But we are so far from those lows, that is gold, the Dow being at a low to gold, or highs, I should say, gold high relative to the Dow. We are so far from those points that we've seen in the past and have typically indicated a fundamental top for gold and a long-term, decline. We're nowhere near that. We're still closer to the bottom than we are to the top. So on all those metrics, I think we can argue different ones will give us something different, but not one of them is saying. And the third thing I would say is that there is no mania. I don't know how it is for you, and you can say if you want or not say if you want, but some of the coin dealers I talk to will tell me that up until the last week, even if they've been busy, it's been as many people calling to